very interesting, your warning around the bond market here.
Yeah.
But I guess the next step is then to work out whether this causes a widespread rush for the exits a la 1987 and the potential to trigger a real sell-off in equity markets,
Yeah.
or whether people say, hey, this is just a bond market phenomena. Let's move to equities where we can find safety and a dividend.
I think the likelihood is that there's going to be segments of the equity market that are vulnerable. So clearly there's large parts of the equity market that have been re-rated for the bond-like characteristics. So the quality, the low growth quality as I would describe it, the kind of consumer staples, some of the clearly beneficiaries of a low rate environment, the bond proxies will be vulnerable. What that means as an aggregate effect is very unclear. But so I think my personal perspective would be to be exposed towards financials. So there are those areas of the stock market that are beneficiaries of rising rates. More cyclical orientation as well, because it's reflecting, the higher rate environment will reflect the fact that the economy is stronger. That's where the earnings upside is. And then the final component here is whether non-US equities outperform the US. Because if you look at where profits are, US profit margins are extremely high, so there's a legitimate question about if wages and interest rates are driving up costs, that you have a problem for US profitability. But if you look at non-US profits, there's lots of areas of the world where they're depressed.
And just to test the premise, we had tantrums in the bond market back in 2015.
Yeah.
I think we started calling it the taper tantrum.
Yeah.
And it turned out to be a false alarm.
Indeed.
Why is it different this time?
Well, I'd say there's two hugely different dimensions to it. First of all, the US economy is a lot stronger now than it was back then. It was doing pretty well back then, but it's a lot stronger now. So, I mean, to put that in context, how well the US economy is doing, John Williams, who's the San Francisco Fed president, who's sort of intellectual sidekick to Janet Yellen, she's coming from the San Francisco Fed as well, he says sustainable jobs growth in the US is 80,000. Now, we got nearly 3 times that in the last payroll series. So the US economy is, if anything, hot from that perspective already. And the other difference is you've got Europe and China accelerating. Now, so if you think that the landscape of the last 7 years is whenever one of those engines has been strong, the other two have tended to be weak. So I think it is a materially different environment to the taper tantrum.